You know, Warren Buffett, he loves businesses you can explain on a napkin. Think insurance, candy, that kind of stuff. So what on earth happens when you take his classic old-school rules and throw them at one of the most complicated industries out there, biotechnology? Well, that's what we're going to do. We're putting the biotech giant Regeneron through the ringer, through the Buffett test.
And this quote, it's pretty much Buffett's entire philosophy in a nutshell. See, it's not about dodging risk altogether. No, it's about knowing your stuff so well, so deeply, that what looks risky to everyone else, well, it's not really a risk to you. So that really brings us to the big question, right? The whole reason we're doing this explainer. How would a guy like Buffett, a value investor through and through, ever get his head around a company that lives and breathes things like monoclonal antibodies and genetic sequencing? I mean, can you really know what you're doing in a field that complicated?
Exactly. And that's what we're about to find out. We're going to break it all down, run Regeneron through a proper case study, and apply Buffett's 4 big tests. Let's see if this cutting-edge company can actually pass his timeless, old-school checklists.
All right, first up, test number 1. Is the business actually understandable? This is what Buffett famously calls staying within your circle of competence. His rule of thumb is, if you can't explain it simply, you have no business owning it.
Okay, so when you look at what Regeneron does, it seems incredibly complex, right? But here's the thing. If you peel back all that complicated science, the business model itself is shockingly simple. At its heart, what do? They discover, develop, and sell these special antibody drugs. They've got this core technology, the VelociSuite platform, that helps them do it. They make blockbuster drugs you might have even heard of, like Dupixent and Eylea, and the business model, it's just sell those drugs, make a ton of money, and pour that money back into R&D to create the next big drug. That's it.
So, that brings us to our first verdict, the first Buffett take. Is the business understandable? Yeah, it is. Look, the science, the biology, that might as well be rocket science for most of us. But the business, the economic engine driving this thing, that's not complicated at all. They sell stuff with great margins to invent more stuff to sell. Simple. It absolutely passes the first test.
Okay, great. So we understand the business, but that's just step 1. The next question is a huge one. Can they protect their turf? Can they defend their profits? This brings us to test number 2. Does the company have a durable competitive advantage, or, his most famous term, an economic moat? And a moat is exactly what it sounds like. Think of a castle. The moat is that big ditch filled with water that keeps the invaders out. In business, it's the same idea. It's this protective barrier around a company's profits. It could be a powerful brand, a portfolio of patents, or just being the lowest cost producer. It's whatever keeps the competition from storming the castle and stealing your profits. And when you look at Regeneron, their defense system is incredible. It's not just one little moat, it's like a 4-layer defense. First, you've got their technology platform, this proprietary VelociSuite tech that lets them discover drugs way faster and cheaper than rivals. Then layer 2, the blockbuster cash flow, just massive recurring revenue from their hit drugs. Third, strategic partnerships with giants like Sanofi and Bayer give them global reach. And finally, the 4th layer, a super deep pipeline. We're talking over 30 drug candidates in development to make sure the hits keep on coming.
And look, when I say massive cash flow, I'm not kidding. Just look at this number. $17.8 billion. That's the projected global sales for just one of their drugs, Dupixent, for 2025. One drug. It's an absolute cash machine that basically pays for everything else. It funds the entire fortress.
So what's our second Buffett take on this? It's pretty clear. Regeneron has a seriously wide and durable moat. Its unique tech makes it really, really hard for anyone else to compete. And that mountain of cash from its big drugs gives it the firepower to just keep making that moat wider and deeper. This thing is built to last. All right, so we've got an understandable business with a killer moat. That's fantastic. But at the end of the day, Buffett is a numbers guy. So let's get to test number 3. Are the financials strong and consistent? Is this company a financial fortress? And wow, what a fortress it is. Let's just take a look at this financial snapshot. You see a solid return on equity, almost 15%. That's good. But here's the real kicker, the balance sheet. They have almost no debt, a debt-to-equity ratio of just 0.10, and they're sitting on over $8.6 billion in cash and investments. I mean, that is just rock-solid financial health. And it really put that profit margin into perspective. Just check this out. Regeneron's ability to squeeze profit out of its revenue isn't just good, it's not even great. It crushes the industry average. I mean, it's not even close. That tells you they have incredible efficiency and some serious pricing power.
Which brings us to our third Buffett take. The financials? They're simply outstanding. We're talking high margins, solid returns, and pretty much zero debt. This is a classic Buffett profile. It's a business that gushes cash. So much cash, it almost doesn't know what to do with it all. Okay, so far, so good. We have a wonderful company, checks all the boxes, but, and this is the most critical test of all, is it cheap? Are we getting it at a good price? Test number 4 is the grand finale. It's all about price versus its real value, what investors call its intrinsic value. So what is this thing really worth? Well, as you can see here, valuation is more of an art than a science. Different models spit out different answers. You've got conservative estimates based on projected cash flow down around $666 a share, and then you have super optimistic models that put it over $1,500. The main takeaway here is that intrinsic value isn't one magic number. It's a range, a ballpark estimate. And that's why this Buffett quote is so perfect for this situation. He always says, "It is better to be approximately right than precisely wrong." You don't need to know the exact value. You just need to be confident that whatever you're paying is a good deal less than what it's generally worth.
And that idea leads us straight to the holy grail of value investing, the margin of safety. Let's look at this. If we're conservative and say the company's real value is somewhere in the $860 to $900 range, but the market is only asking us to pay around, say, $761 to $785, well, that gap between the two, that's your margin of safety. It's your cushion. It's your buffer in case your estimates are a little bit off. So that gives us our final Buffett take. Is there a margin of safety? It looks like it. Even when you're being cautious with the numbers, it seems like the company is trading for less than it's probably worth. And with that, it passes the fourth and final test.
All right, we've gone through all 4 tests. Let's put it all together now. After running it through the Buffett gauntlet, what's the final verdict? Does this futuristic biotech company actually make the cut? Does it belong in a Buffett-style portfolio? Now, I know what some of you might be thinking. The stock has shot up 41% recently. Isn't the party over? But here's what's so important to understand. You have to look at why it surged. This wasn't just random market hype. This was driven by the business getting stronger. We're talking massive growth from their main drug, getting big wins with regulators, and real progress in their pipeline of new drugs. The market is recognizing real, fundamental value creation.
And that brings us to the final scorecard. Look at this. Regeneron passed every single test. An understandable business? Check. A wide and durable moat? A strong check. Fortress-like financials? Absolutely. And, the kicker, a margin of safety? Check. It's a clean sweep.
And it all comes back to this one final quote, which is maybe the most important lesson of all from Buffett. He's not out there hunting for dumpster diving bargains. He's trying to buy a wonderful company at a fair price. And you know what? After everything we've looked at, it seems like this complex, modern biotech giant might just fit that description perfectly.